In the financial arena, choosing between mutual funds and ETFs can feel like navigating a tangled jungle. While both offer diversification and access to a plethora of assets, their subtle nuances can obscure the optimal path for even seasoned investors. So, before you embark on this financial safari, let's equip you with a magnifying glass to delve deeper into their hidden complexities and illuminate the way towards your investment oasis. The surface differences between mutual funds and ETFs lie in their trading and structure. We already explored how mutual funds resemble closed societies, calculating their price once daily based on their internal holdings, NAV. But, within this seemingly static structure, a dynamic drama unfolds. Skilled portfolio managers meticulously research and select individual securities, aiming to outperform the market. This active management, however, comes at a premium, reflected in higher expense ratios. Passively managed mutual funds, like index funds, operate more like serene Zen gardens. They meticulously mimic a specific market index, e.g., S&P 500, mirroring its composition with unwavering fidelity. Their goal? Not to conquer the market, but to harmoniously blend with it, offering lower fees and broader diversification through their automated, rule-based approach. Now, ETFs cast a spotlight on a bustling marketplace. Imagine them as vibrant bazaars on exchanges, where their price fluctuates throughout the day based on the whims of supply and demand. You, the intrepid investor, navigate this dynamic dance, buying and selling directly like haggling over exotic spices. This real-time interaction empowers you with immediate entry and exit options, granting greater control over your investment journey. But, even within these distinct structures, hidden layers emerge. Actively managed ETFs, though rare, exist, utilizing the exchange-traded platform for their nimble transactions. They offer a unique blend of real-time trading and active management, appealing to investors seeking a potent cocktail of control and expertise. The financial jungle can be rife with hidden thorns, and fees and taxes are no exception. ETFs generally hold the advantage here, their exchange-traded nature translating to lower operating expenses and, consequently, lower expense ratios. This cost efficiency can significantly impact your long-term returns, gradually compounding into a sizable difference over time. However, tax efficiency, like a cunning chameleon, changes color depending on your trading habits. Frequent buying and selling of ETFs, while offering the thrill of real-time control, can trigger unwanted capital gains taxes, negating some of the cost benefits. Mutual funds, with their once-daily pricing, offer some tax deferral benefits, as gains or losses are only realized when shares are sold. The key lies in finding the balance between the immediate gratification of ETF trading and the tax deferral potential of mutual funds. It's a delicate dance, and tailoring your investment strategy to your risk tolerance and trading frequency is crucial to waltzing away with the most favorable tax outcome. Not all paths in the financial jungle are equally welcoming. Mutual funds often erect formidable gates in the form of minimum investment requirements, sometimes as high as $3,000 or more. These can be daunting obstacles for novice adventurers, limiting their access to diversification opportunities. ETFs, however, act like friendly village markets, offering their wares through fractional shares that even the most budget-conscious traveler can afford. This democratization of investing allows everyone, regardless of their financial stature, to embark on the path towards financial freedom. But accessibility comes with its own set of considerations. Mutual funds offer a plethora of purchase options, including lump sums, automatic installments, and even dividend reinvestment plans. This flexibility allows you to customize your investment journey, pacing yourself as you navigate the terrain. ETFs, while primarily dealing in lump sum transactions, are catching up, with some platforms offering automated investing options to cater to the diverse needs of modern investors. In the ever-shifting sands of the financial desert, liquidity is your lifeline. ETFs, with their real-time trading on exchanges, offer a shimmering oasis. You can buy and sell at any point during market hours, entering and exiting your positions with the swiftness of a seasoned nomad. No more waiting for end-of-day price adjustments or queuing in the hopes of securing your desired price. Mutual funds, however, can feel like sluggish camels plodding through the desert. Their once-daily pricing introduces an element of delay, leaving you vulnerable to market movements between your order and its execution. If swift action and immediate decision-making are your compass, ETFs provide a more fluid and responsive journey. The ability to steer your investment journey is invaluable. With ETFs, you wield the reins directly, navigating the market in real time like a captain commanding a ship. You decide entry and exit points with precision, reacting to news or market movements as they unfold. This active engagement can be exhilarating, empowering you to capitalize on fleeting opportunities and minimize losses. However, it also demands constant vigilance and a strong understanding of market dynamics. Are you prepared to weather choppy waters and make quick decisions under pressure? Mutual funds, in contrast, hand the helm to skilled skippers, the fund managers. You trust their expertise and experience to navigate the complex currents of the market, plotting a course towards long-term growth. This passive approach offers peace of mind and frees you from the daily grind of analysis and decision-making. But, just like entrusting your fate to a captain, you relinquish a degree of control and must rely on the manager's skills and vision. Do you prefer the steady hand of experience or the thrill of charting your own course? Every journey, financial or otherwise, is fraught with its own set of risks and rewards. ETFs, with their immediate trading capabilities, can amplify both. Gains can be maximized by swiftly seizing opportune moments, but losses can also snowball if decisions are impulsive or ill-timed. The constant exposure to market fluctuations can be exhilarating for seasoned investors, but nerve-wracking for those prone to anxiety. Mutual funds, with their single daily price point, introduce a layer of insulation from short-term volatility. The smoothed-out performance can be reassuring for risk-averse investors, providing peace of mind amidst market turbulence. However, this also dampens the potential for explosive gains that might be captured through nimble ETF trading. Are you more comfortable with a steady, predictable journey or drawn to the adrenaline rush of navigating volatile waters? Both mutual funds and ETFs offer invaluable access to diversification, a crucial tool for mitigating risk and building a resilient portfolio. By spreading your investments across a variety of asset classes and sectors, you minimize your exposure to any single market downturn. Mutual funds often come prepackaged with built-in diversification, neatly allocating your capital across a range of securities based on the fund's stated objective, e.g., growth, income, value. This one-stop-shop approach simplifies portfolio construction and saves you the time and effort of researching and selecting individual holdings. However, you relinquish some control over the specific assets within the fund and may not perfectly align with your individual risk tolerance or investment goals. ETFs, on the other hand, grant you granular control over your diversification. You can choose from a vast array of ETFs targeting specific sectors, industries, or even themes, e.g., clean energy, cybersecurity. This flexibility allows you to tailor your portfolio to your unique preferences and risk appetite. However, it also requires research and effort to select the right ETFs and build a balanced portfolio. Are you a fan of convenience or do you enjoy the freedom of building your own diversified haven? Ultimately, the choice between mutual funds and ETFs hinges on your long-term financial goals and risk tolerance. Are you seeking steady, gradual growth over the years, or aiming for more aggressive potential returns? Are you a hands-on investor who thrives on active engagement, or do you prefer to set it and forget it? Defining your North Star will guide you towards the investment vehicle that best complements your path. No matter which route you choose, remember that both mutual funds and ETFs are valuable tools for achieving your financial goals. The key lies in understanding their unique strengths and weaknesses, aligning them with your individual needs and risk appetite. With careful consideration and informed navigation, you can chart a course towards financial success, navigating the financial jungle with confidence and clarity.